But first of all, just a big welcome and thank you for joining us. I think we are really excited for today's session. For those of you that don't know me, my name is Jason van Staden. I am part of the innovative finance team at the Bertha Centre and co-convener for the Impact Investing and Africa course. Part of that team with me is Shaluba Mawela from Shiamo Impact, who's waving there. We've been convening the course for the past 3 years together. Really incredible course. And yeah, we're just really excited that we can be hosting this webinar where we're really going to look to showcase some incredible success stories on the African continent of how impact investing is being used and utilized to really drive more impact across the continent. So maybe just to kick us off, I'm going to prompt Avibe, who's also a key part of our team, to maybe just share a mentee poll. We are keen to hear from all of you in the room how you define success when it comes to impact investing on the African continent. So please feel free to scan the QR code that is on the screen or go to mentee.com and put in the code that is below it. And yeah, just then write what you feel is a definition of success or what you feel would be a success on the continent in terms of impact investing. Yeah, some of the answers are coming through. Got economic prosperity, sustained change in outcomes related to quality of life. Good, change in lives. Promoting local ownership in a sustainable long-term way that builds capacity. Sustainable and stable growth in impact and finance returns. Economic value. See a lot of sustainability coming through. Inclusion as well. Very important theme. Sustained livelihoods. Global impact. Okay. Increase in earnings and wealth. Finance, empowerment, and inclusion. Cool. I mean, keep those responses coming. We definitely value it. And yeah, I think it is really a question we need to grapple with as well as to what does success look like, especially if we want to be showcasing that success on the African continent. And I think that's why, at least for me, it's very exciting, this particular webinar. And I think it's also for us as a team and the Impact Investing Africa course. We've seen so many success stories of attendees that have come onto the course and then walked away from the course and gone and started incredible companies or initiatives or projects which has driven such incredible social impact on the continent. And so that's really been one of the inspirations behind this webinar, is seeing that success that has come from our alumni. And yeah, just knowing that, particularly on the African continent, where there is this perception of risk, can we actually deliver the returns? Can we deliver on the impact that we need to be showcasing? We need to be showing the evidence for the success that we are having on the continent, and not just what is perceived as a global success, but as Africans, how do we define that success, and demonstrating that and seeing how we are creating sustainable livelihoods, how we are changing lives, and how we are moving the needle forward, and really moving towards that prosperity and prosperous Africa and continent. So it's really exciting. And today we have the privilege of three incredible speakers, all in their own right have kind of paved that way of showing what success looks like in terms of impact investing on the continent, and each from different lenses. So we have one from a social enterprise that's actually gone and making an impact on the ground, and changing people's lives with innovation in terms of products and services. We have a fund manager as well, and then we also have innovative finance mechanisms. So we're going to be demonstrating that, and even multiple blended of those in each of the different initiatives. So I'm really excited for that. And to kick us off, I'm going to hand over to Shaluba, my co-convener, who's going to introduce our first speaker.
Okay, awesome. Thank you so much, Jason, and welcome to everyone who's joined the masterclass. We're really excited to have you here. As Jason has introduced me, I am Shaloba. I'm a co-convener on the Impact Investing in Africa course. I'm also the founder and managing partner of Tiamo Impact Partners, which is an impact advisory and boutique asset management business. I'm so honored and really pleased to welcome our first speaker, Adesuwa Rhodes, who's the founder and CEO of Aruwa Capital. Adesuwa is an experienced finance professional with over 15 years of experience across investment banking and private equity from global institutions such as JP Morgan. At the age of 29, she launched Aruwa Capital as a first-time female fund manager and has built an $80 million gender lens investment platform across two private equity funds, investing in high growth businesses across West Africa. She's one of the youngest private equity fund managers on the continent and the first female solo GP to raise more than $10 million in an institutional first fund in Nigeria. Today, Adesuwa will share the perspective of a fund manager building and scaling a gender lens private equity fund in Africa. Welcome.
Thank you. Thank you, Shabula. And it's great to be here. Thank you for having me. So I'm just going to share my slides and just give a bit of an intro into what we do at Aruwa Capital, our thesis, why we have that thesis, some of the successes that we've had to date, and then we'll open it up for questions from the audience today. So Aruwa Capital, we're one of the few women-owned and managed funds on the continent, based here in Lagos, and we're a growth equity fund manager that's predominantly investing in West Africa, specifically Nigeria and Ghana. I've been on the ground for the last 12 years, but Fund 1 was launched in October 2019. We have $80 million across two funds. So Fund 1 is a $20 million fund that's invested in 11 companies. Fund 2 is a $60 million fund that's now invested in 5 companies, but will be investing in 10 more companies in the next, call it 18 to 24 months. We're 15 investment professionals, but a team of 19 in total. And we're really pioneering the SME and gender lens investing space. So we're investing in companies that are too late or not techy enough for the venture capital ecosystem, but are too small for majority of the private equity funds who want to deploy larger pools of capital into businesses. So we're typically investing on average between $1 to $3 million into established businesses that just require that incremental growth capital to scale. We've shown financial returns above global benchmarks in Fund 1. So Fund 1 has really proven out this strategy where when you invest in SMEs and when you invest with a gender lens, you're able to showcase significant return, but also significant impact. Some of our investors include the likes of Visa Foundation, Mastercard Foundation, British International Investment, FSD Africa. We've also been able to mobilize local institutional capital as well. A little bit about me, the last kind of 18 years or so in investment banking and private equity, and decided to step out on my own in 2019 to launch Aruwa. We have a very diverse and multidisciplinary team. So 15 investment professionals. We also have a head of ESG and a head of finance, finance manager that's also supporting the infrastructure. I think I saw our head of ESG on the call. Hi, Chooks. We have a very robust investment committee as well, that enables us to make sure that we have experienced investors as well as experienced operators being involved as we appraise and review these investments. Thankfully, we've been able to be, recognized by a number of industry bodies, by a number of, Private Equity Africa, Africa Private Capital Association. So we've managed to win some awards over the years that really just showcases the track record that we have in impact investing to date. We also publish a lot of research. So go on our website. We kind of really publish research as to why we invest with the way we invest. So we published, why we invest in women. We've published how to invest in more female fund managers. On our last count, there's only 39 female-led funds in the whole of Africa that have closed their funds. So we're quite vocal about our thesis and why institutional investors should be investing in small businesses and should be investing in women. I always like to show this slide, which really showcases our positioning. So you have a lot of venture capital firms that are pre-seed and seed, mostly investing in tech-enabled businesses, investing in 30 to 40 businesses in a fund, and hoping, the power of, the power law, 2 to 3 return the fund. That's not our model. We're also not a large private equity fund that's managing hundreds of millions of dollars. We're in this missing middle, which is a really, true missing middle, where businesses are too late for traditional venture capital, not techy enough for traditional venture capital, but they're too small for most of the private equity funds in the market who need to, deploy at least 10, 20, 30 million per transaction. So in Africa today, we estimate that the gap in this segment that we're filling is more than $150 billion. So our $60 million fund two is not even scratching the surface of what's needed. But that means that we can really cherry pick the deals that we want to do, and we have the luxury to choose. Because you have a lot of businesses on the continent that are looking to raise $1 million or $3 million. You don't have a lot of businesses on the continent that can absorb 20 million or 30 million. So we think that this space is a very attractive space to invest in, where you can generate risk-adjusted returns, but you can also amplify and significantly amplify the impact that you're having when you also create growth capital in this space, in terms of job creation, in terms of poverty alleviation, and so on. We've managed to invest in some of the fastest growing businesses in Africa. So Omni Retail, which is a business we invested in, was named by the Financial Times the fastest growing company in Africa for 2 years in a row. So very proud to invest in, businesses like that. In terms of our thesis, we're investing in basic needs. So it's financial services, healthcare, essential consumer goods like food, and also access to power through clean energy. As we invest in these must-haves in what is a rapidly growing and urbanizing population, then we believe our portfolios remain defensible, they remain non-cyclical, they remain recession-proof. And I think this is also one of the keys to our success to date as well. In terms of the themes that kind of underpin these sectors, we have 6 themes that we invest alongside. So import substitution and local manufacturing is a big one. Enabling of micro SMEs. So I always talk about the informal economy, which makes up about 95% of trade in Africa. If we can find businesses that are providing payment infrastructure, providing logistics, providing working capital, providing, that digital layer to these micro SMEs, we think that that is a very attractive opportunity. We're investing in tech-enabled healthcare delivery. We're investing in financial inclusion, where I think only 43% of people in Nigeria have access to bank accounts. So if we can get them access to, financial products in underserved areas, we think that's quite exciting. We're also investing in businesses that have geographical diversification, so are exporting, are operating in multiple countries. And then climate change and adaptation, where 700 million people lack access to electricity. If you can find businesses that are providing, clean energy access in an attractive way, then we want to also invest in those businesses. So these are the 6 themes that kind of underpin our portfolio. And we've seen that this really showcases large-scale job creation, gender equality, but also superior returns. We invest with a gender lens. Some people have this misconception that we only invest in women. That is not true. We invest in female-founded or female co-founded businesses, or female-led businesses, which could be male-founded, but have at least 30% of their management team being women, or businesses that provide essential goods and services to women, or businesses that have women predominantly in their value chain. So we have a business, Agrekno, for example, that's founded by men, but they have about 15,000 smallholder farmers that they work with, where 90% of those are women. So as long as there is significant impact of women in the value chain, it could meet our gender lens thesis. People also ask, how do you assess what you invest in? Companies have to have a minimum of 2 years track record, annual revenues of at least 500,000 to 1 million. We want to see growth, high gross margins. We want to see historical growth. It's always growth capital. We're not looking to, do replacement or refinancing capital. And Nigeria and Ghana remain a very key focus of our mandate. So why do we invest in women? We also get this question sometimes. So today, less than 2% of capital is going to women. Africa has the highest rate of female entrepreneurship in the world, 4 times more than Europe, but still lacks access to capital. We think women represent a very untapped investment case. If the gender gap is bridged, another 28 trillion could be added to GDP. We've seen that gender diversity increases profitability, increases valuations, increases revenue. We've seen it in our own portfolio, where 70% of our portfolio is female founded or female led, and we've seen on average 23x revenue growth since we've invested. So we don't think that that's a coincidence. But also, when you invest in women and when you empower women in your value chain, they're reinvesting 90% of their income into healthcare and education. So there is also that seamless intersection between profit and purpose when you invest in women. We've seen, phenomenal impact metrics across our portfolio as well, where we're supporting over 200,000 direct and indirect jobs. About 3,600 of those are direct jobs. We've seen gender equality across our ownership, across our boards increase. We've seen value chain prosperity in our portfolio. So we're really showcasing that as you invest in SMEs with a gender lens, you can have a top quartile performing fund, but you can also showcase very, very attractive impact metrics. We also get the question on how we add value. Let me know if I'm out of time or how much time I have, but I'm wrapping up. But do I have enough time to continue? Yeah? Okay. So we also get asked, how do we add value to the companies that we invest in? So we always sit on the boards of the businesses that we invest in. We always help them with finance function upgrades. So whether that's helping them install an accounting system, whether that's helping them hire a CFO, we help them with client acquisition so we can leverage our networks to help them grow, help them enter new markets. So we're quite a hands-on investor. And I think because we sit in Lagos and we invest in Nigeria and Ghana, we have that benefit of being able to have the proximity to our founders where we can, go to an office in 20, 30 minutes for a strategy session. So being on the ground and having that proximity helps us to be able to drive value creation effectively. We have a rigorous process, a 2-step IC process. We have about a 2% selectivity rate. So out of 903 deals that we've screened, we've only done 16. So because of that mismatch of supply and demand, we have the luxury to choose, and I think that that helps us in being able to showcase some of these success metrics as well. So that's a little bit about us. happy to take any questions on our thesis, on what we look for. Thank you for listening to me.
Awesome. Thank you so much. I think that was really amazing. So yes, we're going to open the floor. Any questions, any comments? And please do raise your hand and then we'll select like that. And then when you do ask the questions, we do encourage you to please unmute, and also if you can, just show your camera as well so we can see who you are and get to meet you. Kudos, go ahead.
Can you hear me?
Yes, can hear you. Go ahead.
Good morning. Sorry, I hope you can see me. Sorry. Okay. Good afternoon. Adesuwa, congratulations on what you're doing in Nigeria. I think it's needed. Say in terms
Thank
of
you.
the investment opportunity. I think I saw you featured on a podcast, so that's how I got to know about you and what you do. I want to ask a question because you play within the private equity, and I think for me, who is an investor, although I'm in a specialized niche, I'm in the life sciences. I noticed there's
Okay.
some misconceptions in Africa in terms of the type of funds created and what type of funds entrepreneurs can access. Someone like myself who is trying to produce drugs and vaccines, it's very difficult to get funding for that. And I'm not the only one. You also have established companies that are trying, although there have been promises of funds from the World Bank, the African Development Bank, and other people to access to help. And this followed during COVID-19 when Africa could not access vaccines and all of that. So, in your experience, what would you advise someone like myself to start? Because I picked a niche market, which is clinical trial, because you need that if you're going to go into vaccine development, because you need to know the type of drugs that will be needed for the market, like in Nigeria. And we've noticed that there's been an exit of players, GSK, Kimberly Clark leaving the market. So it's creating a gap in there. You have different models that we suggest, fill and finish, end to end, and all of that. So I just want to ask your advice for someone like myself.
Yeah, sure.
And from your experience,
Sure.
how would one go about that? Because it's a
Sure,
needed
sure.
market, it's a needed sector, but there are
So
challenges
I'll
in
just
accessing that type of funding.
sorry to
Thank you.
interrupt, but I know there are other questions.
Yes.
So no, I think yes, there are a lot of there are some investors that actually specifically invest in healthcare. So if you were to just, put into Claude or put into ChatGPT, give me a list of the top 10 investors in Africa that have invested in healthcare or invested in life sciences. Go to their website, find out who the partners and the teams are, reach out to them in LinkedIn. I don't know if you've heard of HealthCap, but there's a VC investor, HealthCap
Yeah,
here in
head of health chat.
Nigeria.
Okay. Yes. Okay.
Dr. Ola Brown is
Yes.
actively
Yes.
looking to invest in healthcare and fintech.
Okay.
Leapfrog, obviously a little bit
Yeah.
larger. But there are a few investors here and there that actually are looking for healthcare investments. But you should also tap into angel investing networks as well. If you're in an earlier stage, then tap into the angel investing networks in your country, and see if you can do a pitch to some angel investors who may have a preference for life sciences, who may have a preference for healthcare. But it's really about just, it took me a long time to fundraise, and I think
I
what I
can see
always
that. Yeah.
did was just reach out, cold emails, do your research, reach out on LinkedIn. And if that person is not investing, they could potentially introduce you to someone that can.
All right. Thank you very much. Thank you.
Thank you. On that point of fundraising, like, do you have kind of any advice or tips for anyone who's in the process of fundraising for a fund? Like, what did you find worked out for you, and really got you to that point where you could actually start getting the funding through the gates?
Yeah, so I think for me, the lesson that I learned was just no matter how small, just do your first deal. So I always say to aspiring fund managers that, when you're able to take the conversation away from a pitch deck to an entrepreneur that has decided to partner with you and decided to take your capital, and that company is aligned with the thesis that's in your pitch deck, then it takes the conversation with the LP to a completely different level. So, when I first started, I was taking as low as $2,000, 2,000, 5,000, $2,500, $5,000, putting people in SPVs, and just trying to do those first deals before I then got the attention of Visa Foundation 2 years later. So it's about coming together, dropping every ego, reaching out to your friends, reaching out to your family, raising small pools of capital, and doing that first deal, because it just takes your pitch to a whole different level if you can talk about an entrepreneur in a company.
No, thank you. That's amazing. There are 3 more questions, so we're going to cap it at 3. So, Kalagot.
Okay, thank you. I hope you can hear me. Can you hear me?
Yes. Yes.
Okay. Thank you so much. First, I just want to say you really inspire me, Adesuwa. Thank you so much. When I saw your videos, I was like, this is me. Thank you. So,
Thank you.
I'm currently managing funds of about $1 million, and I am in a situation where I have to return funds of up to 10 million because I don't think I'm there yet. And so one of the HNIs I was speaking with recently said, because I was trying to explain to him why I can't take his money. And so he said, so what you should do is work out how to manage 20 million. So right now I'm comfortable with 10 with 1, but I'm not there yet at being able to manage 10. So what I want to ask is for advice. How do you build that roadmap to manage up to 20, 30, $80 million and actually return, investments? What we do is with SMEs, we also do reward assets with the blockchain space. So we tokenize the SME private credit, put it on chain, sell it to the global north and everyone else, and we'll pay a premium. On our own end, we loan to the SMEs at a slightly higher rate. So we're able to make money that way. We also do investments on revenue generating businesses. But the greatest challenge I have is, so if I get $10 million now, how do I scale this a lot bigger without getting overwhelmed? So I'm just sort of like asking for advice on that, because I think a clear example of what my future would be. Thank you.
No, well done on what you've already raised so far. That's very, very exciting, incredible. So well done. I think it's all about building capabilities internally and making sure that you have the right people and the right team. So just to take on my own experience, when I started Aruwa, there was 3 of us. When we raised our first fund at the end of 2022, I believe there were 6 or 7 of us. And now, where we are now, there's 19 of us. So at each stage of your growth, you're gonna require different types of support. At the earlier stages, it's really more about execution. It's really more about, making sure you have people around you that understand the thesis, that can do the deals, that can, make sure they originate the right transactions, that can do the portfolio management. As you scale and you have a much bigger portfolio, then you need to start thinking about institutionalization as a manager. So do you have, an accounting system in place? Do you have an LP reporting dashboard where your LPs can see their information live on a portal? Do you have a finance manager? Do you have someone that's, tracking ESG? So I think at different stages of your growth, you will need different sorts of support, but it's really down to people, and it's really down to having the right structures internally to be able to scale as a manager. But happy to take the discussion offline. If you add me on LinkedIn, happy to kind of share more about how we kind of grew at every stage with the teams that I hired.
Yeah, I already follow you on LinkedIn, so if you could
Okay.
accept the request, it would be
Okay,
great.
I will. Sorry, I got a lot of requests in the last.
I understand. Thank you so much. I'm so grateful. Thank you.
Thanks so
Well
much.
done. Well done.
We're going to take 2 more questions. In the interest of time, we're going to ask the next 2 participants to maybe keep their questions a little bit shorter. So we're going to do Malebo, then Adesuwa. And then if there are any other questions, feel free to pop it in the chat. And then maybe Adesuwa, before she leaves, she can maybe just have a look at those and answer those. But over to you, Malebo, I think.
Thank you so much. Unfortunately, I won't be able to switch on my, my video. I'm off sick, but a very quick one, Adesuwa. You mentioned that a lot of businesses, so I'm asking from a entrepreneur point of view. You mentioned that a lot of businesses are ready for a 1 million funds, but not necessarily a lot in the growth phase. From the businesses that you have seen, screened, and interacted with, what do you think is the barrier, particularly for African female-led entrepreneurs to get to that phase of growth and requiring bigger investment? Thank you.
So just to clarify, what I was saying was that there are not many companies in Africa generally, not just female-led businesses, but there are not many companies in Africa generally that can absorb 20 million or 30 million. Just because of the stage of development that we're in. In my part of the world, I know that might be different in Southern Africa, but in my part of the world, we don't have a lot of, in Nigeria or Ghana, there are not many businesses that at once can take 20 to 30 million. But to your point generally, I think that we don't have deep enough capital pools at each stage of the capital stack. So we have very deep capital pools in the larger fund segment. We have kind of okay capital pools in the VC segment that's kind of maturing now. But in the space where we sit, where it's kind of that bridge between VC and PE, we don't have a lot of funds that are willing to write a $1 to $3 million check. So I think what's preventing companies from scaling is there needs to be deep capital pools across each segment of the capital stack. Because if you have a lot of VC funds, but then at the next stage, there's no one to fund them so that they can then get to the next stage for private equity, that gap in the capital stack can limit their growth. So I think that we need more Aruwas. We need more funds that, say actually deals below 5 million are worth my time. We have too many fund managers now that just think any deal below 5 million is not worth their time, and they're not getting out of bed for deals less than 5 million. So if we can address those different segments and have depth in each pool, then I think more companies will be able to scale.
Great. We'll go to the last question, Adesuwa. You muted,
You're on
Adesuwa.
mute.
Thank you. Hi,
There we go.
everyone. Sorry about that. I'm just interested to know if there are any LPs that you have said no to or ones you do not actually want and why, and what your experience with your local. I see you've got quite a number of DFIs and international LPs. What's the landscape like in your own country? Are there any, institutional investors that are interested? What's been your experience like? And then lastly, what is your biggest challenge at this stage of your growth?
Thank you. No, those are good questions. So the first one, are there LPs I've turned down? Definitely. I think that similar to how a business may want to turn down an investor, a private equity investor, because it's a long-term marriage, similar fund managers should also be very, very cognizant of the type of LPs that they're bringing into their funds, because it could potentially be a 10-year marriage, rather than a 5-year marriage like an entrepreneur. So yes, I've definitely turned down investors in the past where I just felt there wasn't an alignment of values, or I felt, for the value that they were bringing, it wasn't worth my time or the stress. But I think it's important that, fund managers and entrepreneurs always do a two-way DD process and assess if the person that you are talking to is someone you want to be, interacting with for 5 to 10 years. In terms of LPs that are local, yes, we've mobilized local institutional capital. So Bank of Industry is one of our Fund 2 investors, which is the Nigeria DFI. We've also mobilized capital from a local pension fund, from a local insurance company. So I'm very big on local capital mobilization because I think until we start funding ourselves, a lot of the issues in the private equity ecosystem will not be addressed because, I'm not going to be too controversial on this call, but, we need to have skin in the game. And if Africans are not funding African fund managers, if Africans are not funding infrastructure gaps, SME funding gaps, then we'll keep on doing the same thing and expecting different results. So with the pension assets that we have in the country, across the continent, we need to put that into work in private equity and infrastructure. In terms of the challenges that I have now at this stage of growth, to the glory of God, fundraising is no longer a challenge. I would say it's really finding the right team, scaling the team. It's more about how do we institutionalize as a manager. So building the team, growing the team, starting to think about how we expand to other markets, how we expand to other asset classes. Those are the type of challenges I'm thinking about now. How do we exit our investments in Fund 1? So those are some of the challenges that I'm thinking about. As I started off as a manager, fundraising was my main challenge. Thankfully, Fund 2 is now closed. But as we grow, as we scale our assets under management, it's more about institutionalization, teams, systems, expansion, new markets, exits. Those are the things that are keeping me busy.
Great, amazing. Thank you so much, and thanks so much for the questions. If there are any other questions, as mentioned, please do pop it in the chat, and then Adesuwa can have a look to see if she has capacity to answer those. But for now, I'm going to hand back over to Shaluba, who will close and then introduce our next speaker.
Okay, awesome. I think thank you so much for all those questions. Do keep continuing the conversation in the chat. I'm now honored to introduce our second speaker, Murendeni Mafumo, a water scientist, social entrepreneur, and the founder and CEO of Kusini Water. He has spent over 15 years of his experience designing and building water systems across the continent. His experience spans public sector water and sanitation, infrastructure delivery, having previously served as a water scientist in the City of Cape Town's Water and Sanitation Department and as a civil engineer at Joburg Water. Through Kusini Water, Murendeni has developed water treatment solutions that use locally sourced waste macadamia nutshells and nanotechnology to provide clean drinking water to underserved rural and informal communities. Today, Murendeni will share the perspective of a social entrepreneur building an impact-driven enterprise that responds directly to community needs. Welcome, Murendeni. Over to you.
Hey, hello everyone. I hope you. Thank you so much. It is so weird to hear your bio being called out, being read out in when you're there. So, anyways, thank you so much once again, Iviwe, Shiluba, as well as Jason, for this opportunity and such a great speaker as well as program, and not just program but great initiative and what's the word I'm looking for? Amazing organization that just came before me. As mentioned, my name is Murendeni. I work at Kusini Water. I am currently the CEO and founder of Kusini Water. Our main objective is on becoming Africa's manufacturer of locally sourced waste macadamia nutshell filters, and we want to be in the forefront of decentralized water access systems that are community owned. That is important. That shouldn't be taken for granted because in the African continent, 50% of all projects fail within the first 2 to 3 years. And generally speaking, it's mostly because one, generally they don't have a inherent sustainability component, but secondly, more importantly, communities don't have a sense of ownership of those those initiatives, especially in the water, sanitation, and other services. So we want to be able to create a much more locally owned, a little bit more indigenous-based solution for that. I spent the better part of my first part of my career in public sector, and the job that I had in the public sector was primarily focused on increasing access to clean drinking water in areas where there's already water. I worked in the 2 metros in Johannesburg as well as Cape Town. One of the things that we took for granted was that in the country, in South Africa, over 11 million people do not have access to clean drinking water. So their solution is not that of a tap. In Africa, I mean, in the SADC region, over 300 million people don't have access to clean drinking water in our region. And this is based on the World Health Organization data, but also on the UNDP goals, SDG goal number 6. So this is still a struggle that I grew up facing where I come from in Limpopo, but also a struggle that continues in so many parts of our continent. So what's the solution? For me, one of the best solutions for water access or rapid water access is off-grid, locally owned and decentralized. We've got so much sun in this continent. So the solutions need to be one cognizant of those kind of things. So we run decentralized water treatment systems that are powered by solar, that are network effected. So they're networked themselves. They sit per community. So one community would have a couple of these water treatment systems, and they're owned and managed locally. We build and manufacture our systems here in Johannesburg, and we work with other organizations to do things such as carbon offsetting as well. What are the 3 ways? So we are a social enterprise in the purest form, I hope, the purest form, a social enterprise. So therefore that means is that we primarily rely a lot on investment that has the 3 layers. So one, environmental outcomes, secondly, financial outcomes, but also thirdly, importantly, social outcomes. So when we are attracting investment, especially the investors that we have in our books, they are impact investments. So they have a lens for impact first before, not necessarily first, but the lens or the measurement for impact weighs as much as the measurement for financial outcomes, so financial returns, as much as the outcomes for environmental sustainability or climate adaptation. So what our model is pinned on is one, the concept of one, we have to have we sell water directly to communities. So we have a pay-per-use system. So in the communities that we operate in, water is not free. So the people that are using the water, there's a big World Bank study which was done in Lilongwe and Malawi, which was some proof points to show that in communities where you are able to sustain water, most of those communities are prepared to pay for that water. So we sell and we use pay-per-use model. We pay-per-use model because we understand that social outcome and social impact will also have inherently with it economic growth both for the organization ourselves, but also for the communities that we work in. Secondly, we partner for water. So we work with both ESG partners, social impact investors, as well as corporate to rapidly deliver the infrastructure in those communities, but also to subsidize that. And thirdly, more importantly, all of that is underpinned by a water champions model. So the water champions model is a solution that says that in those communities, we will attract, partner, and capacitate unemployed youth to run the treatment systems in their communities for that economic benefit and the access to clean water to be managed and run and owned locally to a large extent as much as possible. So the Water Champions model is a network of young people all around South Africa that are working with us to manage and sustain our water systems in all the communities that we operate in. So basically they champion our systems all around the country. Sorry, I see a hand. I'm not sure if that's a question now. So why is it that we are a good impact investment opportunity, but also why is it that we believe that we stand out? What really do bring? One, we manufacture in-house. Two, we use a lot of indigenous knowledge, the things that we already know. Thirdly, we've got a lot of oversight and visibility over what's happening in our locations. And we have the local IP, proprietary IP that works primarily in low gravity water treatment systems. It's important that as a social enterprise, we can demonstrate our outcomes. So a lot of the outcomes are SDG 6 leading. So one, clean drinking water. So a liter dispense is what we monitor. Secondly, number of people that get reduction in waterborne diseases in our communities, jobs created in our communities, and ensuring that in our communities, as I premised this conversation earlier, we don't want projects to be failing because we know that water projects fail more often than not. So we measure how often our projects are running in those communities. At the moment, sorry, we've got a bit of a typo there, but it's fine. We have over 100 water champions. We're active in about 90. I think this number is probably going to be 97, 98, somewhere there, that 91 number. Soon we're going to be at the 100, the big 100. We are operating in all 9 provinces. We're looking to go into Zambia and Malawi soon. We've got 10 million that circulates annually in the communities. This is income that is both created, generated, and stays in the communities that we operate in. It's the economic. So we say for every rand that Kusini invests, we want to see 4 rands staying in that community as well. We've got about 19.3 in management. So what this basically means is that within those communities that we operate in, we continue to invest in those communities. We continue to build infrastructure in the communities. We continue to build to get more inventory, more mobile systems, and so forth. And we've got about 16 water champions right now that are within the accelerated phase of our program, meaning that they'll be running more than one site. They'll be operating in more than one area. So we've got a lot of partners. I just obviously highlighted a few of our venture backers, and soon we'll be adding Siamo there. I'm sure. Some of our partners are Kio Ventures, which is an impact investment in our infrastructure. So they finance directly the infrastructure. Reckitt, they manufacture hygiene products such as Jig, as many of you would know, Jig Finish. So they partner with us because we ensure that we ensure hygiene in those communities that they operate in. Bank is our biggest funder. They underpin our flagship program, so they give us the most amount of money for our flagship program, as well as E-Squared and I'm an Ashoka fellow. So we obviously have a large market that we're looking to address in our SADC region. 68% of our region does not have access to permanent water infrastructure. That's the people that we are looking to target. And what we're looking to do is by the time that we reach 2030 and beyond, we're looking to be at over 100 million rands in revenue, both within our communities that we operate in, as well as organizationally. So the organization itself, as a social enterprise, exists both in the for-profit as well as non-profit, meaning that the profit that we generate is able to go back into those communities through our non-profit. So right now, by the end of this year, we'll be at well over 100 locations. We want to be serving 2,000 water champions, creating about 1 million impact to about 1 million people. All right. Let me pause there. I feel like I was talking really, really fast. For any questions, and thanks once again.
Great. No, thanks so much, Murendeni. Any questions? Let's open the floor. Just so we can try to get more questions in, I would encourage you, if you can, keep your questions concise. Then we can get more questions in and save some time. Any questions at all?
Can I ask a question?
Yes, go ahead, Adesuwa.
Thanks for the presentation. I'm just interested in the impact investing element. I know South Africa is known not to have a lot of impact investors. I'm so interested to know who those impact investors are, and also, how you measure the impact element, and not just the financial one.
Yeah.
Thank you.
Yeah, I mean, our main impact outcome is on SDG goal 6, one full flow of water. So main outcome would be access to safe drinking water. There's a specific number there that we measure in terms of both a service provided. So increased access would be number one. Two, reduction in waterborne diseases. So there's a impact outcome there because we're able to reduce the number of people within hospital beds or clinic beds in the communities that we operate in. There's a specific outcome number there, or impact number. And so waterborne diseases, access to safe drinking water, access to equitable jobs or good jobs in the communities that we operate in. So those are most of them would be, again, SDG goal 6. Yeah, and you're right. In South Africa, obviously, especially with the BE framework, impact investment is also a little bit cloudy, a little bit complex, because, for example, a big impact investor for us would be E Squared. So they definitely consider themselves an impact investor. So they own some percentage of Alan Gray. So they get a lot of dividends, and it was set up to ensure that the dividends that go into E Squared are used for impact work. So the funds that we get are at very concessionary terms as a result. So because we are able to show the number of jobs, to show access to clean drinking water, to show equitable amount of sanitation services and hygiene, they're able to offset that in their investment. So therefore, it becomes more concessionary. And again, a great, I was talking to, obviously, Shiluba at TMO. They've got a great social impact investment angle as well, where the social impact is weighed as just as much on the model, is modeled just as well as the financial outcomes. Key Ventures, again, the social impact will be again underpinned on the model as well. But yeah, you're right. It's quite a tricky market. There's not a pure impact, a lot of pure impact investors, but there are quite a few. Yeah.
Amazing. Aruwa. Not sure if I pronounced that correctly, but you may go ahead.
Yes, hello. Thank you very much for this. It's been very insightful. And I just wanted to ask, what were some of your biggest challenges starting a career in the water industry, and how did you overcome them? And also, where do you see AI having the most impact in the water industry over the next decade? Yeah, thank you.
Yeah, I mean, there's a lot of challenges, especially in our country, because the industry, even especially when I started, the industry was not as transformed as it should be. So that's one of the biggest challenges that you'd find, that it's not easy to enter into the industry. So the bodies that regulate and manage the industry are not transformed as much. So meaning that as a young Black person, you find it hard to get into those bodies. It's important to be in those bodies because those are the bodies that are setting the regulation, as well as so they're setting the regulation, helping to set the regulation, as well as some of the things that we rely on, like local ownership models in government, because it needs to be regulated. These bodies are the ones that submit to government propositions. It's very difficult to enter into those rooms as a young Black person. It's a very expensive industry to get into on a startup level because it's infrastructure. So it's not so easy to just walk into the industry because you need a lot of financial backing. And as mentioned, there's this missing middle that we've got in our continent, where you're not small enough for grants all the time. You're not that small that you're getting like this small entry level financing, but also you're not big enough for the DBS or the developmental funding. We went to DBSA, we went to IDC, and they simply told us it's just not worth our time. It's just not worth us getting out of bed for this kind of investment. So that's also another huge challenge that we face. I was thinking about this idea of AI. Water quality management is definitely the biggest risk that we face in the water industry. So if we can find ways of using AI to do water quality management, water quality management, water quality prediction and forecasting. Secondly, our water sources are at risk. If we can find ways of managing our water source management, where we can predict and model losses in the future. Right now, the biggest water that we collect, it gets lost in many ways through leaks, evaporation, old infrastructure, and all these things. So AI would be quite handy in modeling loss rates in the system, and modeling demands as well as supply patterns that the communities will need.
Great. Thanks so much, Murendeni. Shaluba, I'm going to hand up to you. I know you did have a question. Want to maybe use that as a close? Or?
Yeah, I was going to ask a question, but I think I've engaged quite a bit with Murendeni. But I see there's a question in the chat from Hillary. I don't know, Hillary, if you want to jump on the mic and maybe ask the question directly. It reads, I'm curious to know how these entities, and Murendeni more specifically yourself, managed to raise their first capital or pen their first investment deal. Maybe kind of walking us through the journey, specifically as a social entrepreneur. My question was just going to be for you to maybe just articulate the importance of structuring, where because you're a social entrepreneur, you spoke about this dual model. So maybe for the purposes of people who are on the call who maybe don't understand why as social entrepreneurs are having to set up in that way.
Yeah. So in terms of the first capital, we definitely got a lot of grants as our first capital. So we got here the Department of Science and Innovation gave us a largish grant to start the model. The Innovation Hub gave us a large grant to start and test out the model. So our initial capital came mostly from grants in the first, I think, 2 to 3 years, which was government grants, the department's innovation grants. We've got an agency called TI that you would know that gave us grants for testing out the model, especially because we had to build a physical product. And then the first investment was came through an impact investor who is a enterprise development fund manager. So these guys get funds from money from enterprise development funds from a large bank. So this large bank needs to spend, obviously, their enterprise development spend, and they invest in programs that can give them direct outcomes in their space. So this was a water company. So they manufacture pumps. So they needed to have direct outcomes in their space because they needed to produce clean water. They needed to produce that for government as almost like a give back to government type of a deal. So that investment was structured as a equity investment in our business in the for-profit arm. But it's at a longer, so it's not a 5-year investment. It's at a much longer investment holding. They don't take a board seat, they don't take directorship, they own equity, and then we report to them once every 6 months or so. So that was a direct capital equity into the business with outcomes of clean water as well as, financial returns as well, right? Now, as a social enterprise, we are structured as both for-profit and non-profit, because some of the programs that we run, or some of the impact programs that we run in our communities, like Water Champions, a lot of those programs don't generate a lot of outcomes financially. So it's very difficult to get commercial funding for that. It's very difficult to go and attract commercial funding for that. So, and that is important for a model because without the local water champions, it's hard for us to run our projects. So we attract capital through our non-profit arm as a result. So we've got a non-profit, for-profit, 2 separate boards, and those 2 separate boards have 2 separate governance structures, but the non-profit owns equity in the for-profit. So the non-profit owns shares in the for-profit, 2 separate boards, 2 separate management team, and then we're able to attract soft capital. We're able to attract impact capital directly onto the non-profit. We're able to attract equity capital. We're able to attract loans in our for-profit, and then we're able to then attract water champions, because we need to train these water champions. And then it becomes impractical to train them because there's not a lot of investors that will invest in that. I hope that makes sense, Shilu.
It does. Perfect. Thanks, Murendeni. Can we maybe just give a virtual round of applause for Murendeni? And yeah,
Thank you so
I
much.
think I'm going to invite our next and definitely last but not least speaker, Batya Blanca, to bring up her slides. And I have the privilege of introducing Batya. So Batya Blancas is a co-founder and CEO of Chancen International Rwanda. Having financed her BS studies with the income share agreement, Batya is passionate about scaling this model in Africa. She has over 10 years of prior management experience and holds an MBA from the African Leadership University School of Business. Batya Blancas is a co-founder and CEO of Chancen International, an organization expanding access to higher education and career pathways through income share agreements. Since 2018, she has led Chancen's growth from a startup in Rwanda to a regional organization financing more than 6,000 students across Rwanda, South Africa, Kenya, and Ghana, with expansion to India soon to be underway. Batya, it's really great to have you. We'd love to hear more about your income share agreements and the great work you're doing at Chancen. So over to you.
Thanks, Jason. And it's great to see so many people on the call. I'm following in the steps of giants, but let's give this a try. I'm excited to share more about the work that we're doing for youth across the continent. So Chancen is a financial inclusion platform that allows young people to finance their education that leads into quality employment. We do this through a unique model, which I'll share a little bit more about in a couple of minutes. We were founded in more than 10,000 youth now, and we operate again across 4 countries. So the reason we exist is really for the young people that have been left behind by traditional finance. For really low income rural youth, especially young women who cannot access any financing solutions to cover the costs of their tertiary education, we unlock a pathway through this unique model. Our mission is to unlock lifetime income for young people. So at the core of what we do, it's really a livelihoods play, and we want to ensure that by giving access to high quality education that leads to employment, we see meaningful lifetime income increase and we break the cycle of poverty. 74% of the young people we finance go on into meaningful employment. And ultimately, if we can show that you can lend to young people in a fair and ethical way, we unlock a, sorry, let me just make this smaller. We unlock a possibility of a new asset class. Investing in youth has been overlooked by the financial sector forever. And with the data set and the track record that we're building, we hope to crowd in other financial institutions and more investment into young people. The way that our model works at its core is it's really an alternative to traditional student loans. We provide financing upfront. And so for someone who cannot afford their education costs, and this is everything from tuition fees to laptops to stipends for travel, etc., we provide financing. No one needs to pay collateral upfront, and they don't need to have a credit history to access our product. Our members or customers only start repaying once they're earning above a certain amount. So we only succeed when they succeed, right? The repayments are based on their income. So if someone earns less, they pay back less, and those that earn more pay back slightly more. So it's extremely customized to what someone can afford at the time and where they are in their career. And what's really important is that there's a clear endpoint. It's not a contract that goes on forever. It's capped at market rates, and it is flexible to what people can afford at the time. What's particularly interesting about approaching finance in this way is that it really removes financial risk for women. Women are disproportionately excluded from financial products, especially women who don't own businesses yet or need to further their education. The product is also very flexible because it allows for pauses during caregiving, illness, or unemployment. And it also supports transitions into higher paying male-dominated fields. So we are extremely targeted about working with education institutions in a gender lens responsive manner and ensuring that, for instance, civil engineering in Rwanda becomes more inclusive and allows young women to participate in this program. We also note that the women that we have supported to date, that 93% of them earn way above the minimum wage, and they report feeling more confident because they now have the skills to actively participate in the labour market. At the core of what we do is really aligning key actors around employment. It's not just about enrollment. It's not just around accessing education. Our model is designed by starting with looking at the education provider and the kind of quality education they provide that leads to employment. And this can look anything like a short course, a coding boot camp, maybe even a technical vocational course, or even a university program. It's really demand-led, so it depends on where the jobs are in the market, and then looking at the education institutions that meet this and working with them very closely. So we go through a rigorous due diligence process with an education provider. And once we have partnered with them, we can then provide financing for students who would like to access that provider. The education provider also put in a first loss guarantee. And so I'll get to that in a second when we talk a bit more about how we fund ourselves. But this means that the education provider has skin in the game. For every student we financed, they put down a 20% first loss guarantee, meaning they can only access that money once the graduate has actually, succeeded and achieved a job and entered into a job. The other thing that we do is we're not just a pure financial services provider. We provide wraparound support. We work with people who are at a very vulnerable stage in their life. And the idea here is to make sure that they have all the support they need to be able to excel in their career later, which includes financial literacy training, which is critical with financial inclusion, as well as career readiness. And then we're also building a community of alumni around our students. So we refer to our customers as members, simply put. In terms of impact, this is probably one of the best impact investments you can make in human capital. For every $1 we invest in a young person, we're unlocking $60 in lifetime income increase. So the leverage is enormous, and which is why we very closely align with impact investors. And then more importantly, what we've seen, especially with some counterfactual testing, is that our graduates, for instance, in Rwanda, where we have the largest group, go on to earn 2.8 times the country median income. So we are meaningfully proving that if we can assess the pathway to employment upfront, make sure the right education provider is selected, unlock access, then you can increase someone's lifetime income and really essentially break the cycle of poverty. Elise, for instance, whose quote is over here, she was a single mom, fell pregnant during high school, and was out of education until the age of 24. She tried her best to get into education. Then she met us, applied for a civil engineering program, and has actually just recently graduated and now works for one of the biggest construction companies in Rwanda. And she gets to send her son to school and make sure that his healthcare is provided for, etc., all of which had disappeared when she became a young teen mom and was locked out of her family. Okay, so what does it mean in terms of impact investing and how do we actually finance this? So when we raise money for this product, we actually do it off balance sheet. So Chancen as a whole is a not-for-profit, and we have operating entities in each country that's responsible for delivering this product. But the money we raise that we then on-lend to young people sits in a special purpose vehicle, and our flagship vehicle is called Zamuka, the Future of Work Fund. And we have to date raised about 29 million of a $33 million target size. These are some of the investors that we work with. We use a blended finance approach, and I'll dig into that a little bit more later. But essentially, we were adamant that we want to serve the most excluded young people and have extremely fair repayment conditions. And so what we could afford in terms of capital upfront was basically already limited and set, because we wanted to have a strong impact focus. And so you see here a mix of foundations who usually take sort of the first loss or the long-term patient capital tranche. And on top of that, we've started to attract sort of family offices in Europe, as well as our first development bank, the DFC. So if we look at this a little bit further, so we'll usually lay our capital sort of across 3 layers. You'll have your philanthropic capital, which is really impact first, and it's the most patient. Everyone gets paid in this tranche, but only at the very, very end, and if we're successful. Then on top of that, you can start to layer shareholders, and this would be your impact first investors. So the UBS Optimus Foundation that only makes investments. They will never give us a grant. So they want to see some sort of return, but they know it's a concessional, and they know that it needs to be a patient. And then finally, on the top layer, you can actually put in note holders who have shorter investment periods. Maybe they need to exit within 5 years. They want to see interest payments from day one. And they are sufficiently de-risked because they have preferred shareholders and sort of this philanthropic tier below them. We're at an interesting and exciting point in time. We were founded in Rwanda in 2018. We expanded into South Africa in 2021. We're now active in Kenya and also in Ghana. The Future of Work Fund took quite some time to raise. Raising one's first fund or SPV is pretty hard, but we're excited to close it now, and we're launching our second vehicle just in the next month that will support our scale. And so what capital looks like for us in the next couple of years is, now that we've got a proven track record and we have the Future of Work Fund in place, we're setting up 2 facilities. So something called the Chancen Catalyst platform. And this is really just a grant raising platform. So similar to what was previously explained, it helps us to expand into new countries. It helps us to measure our impact and sort of looks at the building out the infrastructure around Chancen to be able to do this work. So it's a grant facility. And then alongside that, we'll have the Future of Work Fund 2, where we've already got 15 million in soft commitments for a $40 million facility. In this case, we'll actually go with an LPGP structure. And so it'll be a facility that has, preference shares, and then your more patient or junior shares below that. And then incrementally raise funds over the next couple of years to achieve 160 million in total assets under management. That's when we as an organization also start to break even. We're financed about 60,000 students. And we hope at that inflection point, when we have enough data to show that you can really invest youth, we will see more crowding into the space, and actually having local financial institutions and investors take the step and invest in the young people of our continent. So just to close off, I'm representing 108 people, but at our core, we have our managing directors. We have a decentralized structure. Each country is led by a local expert that is there to make sure that we are responding to the real need and the real problem on the ground. So Chancen doesn't look the same in South Africa as it does in Kenya. And then overall, we have an executive team that is primarily responsible for raising funds and managing the sort of compliance and quality across the organization. So that's it from me. I think I'll pause there and open for questions.
Thank you so much, Batya, for sharing just really on your very interesting and exciting model to ensure that there is increased access to education for African youth. I see there's a number of questions in the chat. Maybe let's start there. Obageng, are you able to open the mic? And maybe in the meantime, while Obageng gets ready, Wendy had asked a question around what systems, tools, or platforms are people currently using to track, measure, and report on their impact matrix? Obageng, maybe Batya, while you think through that, let's take Obageng's question, which has also been put in the chat. Obageng, please go ahead.
Thank you very much, Shilub, and thank you very much, Batya, and all the other presentations. This is quite insightful. Batya, you and yourselves, Chancen and Wafunda, like you've done quite a bit of work that's admirable, and that's in building up the idea of an income sharing agreement in Africa, but in particular in South Africa. What's the penetration rate looking like now, particularly because there's the NSFAS model and that changed from the loan model to now the grant and you never have to repay model. And obviously the traditional student loan. So that's the one. And then my second question is just around so not the philanthropic, because I suppose the philanthropic tier of your funding would just provide that as, okay, we're expecting the following kind of impact outcomes. We're referring more to the guys who are saying, okay, we're looking for return. What does that look like? Does that look like 10%, 15%? Like what does your return look or IRR kind of look like for an investor? Yeah, those are my questions. Thanks so much.
Thanks, Obakem. So in terms of I think where we sit in the landscape in South Africa, so you have I would say NSFAS on the one side and then traditional loans from banks on the other side. But in between both of those, there's still a bunch of people that get left behind. So NSFAS is only for young people that go to public universities and meet certain criteria, household criteria, and then traditionally, if they can't get NSFAS funding, you would look at a bank next. But a lot of banks require collateral; they require interest payments up front, and some sort of credit history. And so we sort of sit in the middle of that. I would say that I think that one of our biggest learnings in South Africa, or one of the that's very different to the rest of our countries in Africa, is that we do see a very high preference for bursaries and sort of scholarship type models from young people. So it does, like, the uptake isn't, it takes longer for young people to understand what we're doing, why it's valuable. Very often they'll say, I'll come back once I've heard whether I'm going to get the bursary or not, or whether I'm going to get NSFAS or not. So it is a vastly different landscape to the rest of Africa. But yeah, I mean, we financed about 1,500 young people to date, and they generally fall sort of in that, I think one can refer to missing middle, but not in terms of household income, but just really they didn't get NSFAS, can't get a bank loan, where else do they go? We also work a lot with, we also help over-indebted students quite a bit. There's a huge population of young people that have outstanding debt at university. They don't have access to be able to pay off that debt. And so we have started providing opportunity to cover those costs so they can graduate, get their certificate, and then move into employment. And in terms of returns, so with the Future of Work Fund 1, so the IRR for the most patient capital tranche is 9% after 13 years, so very concessional. And that's to the dollar. Sorry, I just have to emphasize. One of the hard things of all of this is we're raising in dollar and then having to account for currency changes, etc. That's why we need to get to local capital quickly. So 9% to the dollar, and then for the note holders, they get 5%, from day one until we start to repay the principal amount back. So we usually have about a 5-year grace period for note holders in repaying principal, and just pay interest for the first 5 years. Overall, I would say, in Future of Work Fund 2, our weighted average cost of capital is between 7% and 10%, depending on how we're going to blend the capital.
Thanks, Batya. I see we've got 2 hands. Maybe we can take both of them. Carla, if you'll go first, and then Anna.
Okay, thank you so much. Thanks a lot, Batya. So I have one question. How do you de-risk your underwriting? That's it.
That's great. That's straight to the point, into the heart of the model. So I mean, we have an algorithm that we've built out over the last 8 years. Our underwriting process is primarily based on the education provider and that data pathway that we build. So understanding in exactly this sector, what are people going to earn related to this education provider? What are the likelihood of them getting into jobs because they've got the right quality of education, etc. So it's a bit funky because it's almost like we're investing in the education provider as an SME from an underwriting perspective, and then we're using that underwriting to de-risk the student. But another thing is, what's important in this model is not just the underwriting, but the portfolio building. So we're always financing cohorts of students, and the cohorts cross-subsidize, right? So we know upfront in any given cohort there's going to be maximum 10% dropout. There's going to be unemployment, and so we account for all of that upfront in the algorithm, and we know that maybe 70% will repay us, and the 70% that do repay us cover the losses of the rest. And then across different education providers, you then diversify your portfolio further, and then across different countries.
Thank you.
Thanks, Carlo. Great question. Anna, you can go.
Yes, thank you. And apologies, I can't come off video right now, but really thank you for sharing. I am curious what makes the hybrid model necessary for Batya, and what I guess the alternative would have been if you had a purely for-profit model.
Yeah, that's a really great question. So there are two answers to that. So the first is like a strategic decision. And yes, we could have set Chancen up as a for-profit and raised equity into the group. In the early conversations we had, and we seriously considered it, we were concerned that we would be pushed upstream and that we would not be able to solve this for the most excluded young people, because the return profiles are different, right? If we only finance master's degrees and people who go and study at Ivy League universities, then you can build a business model with a much higher return, but that's kind of been solved for already. And we didn't want that kind of equity pressure sitting at the group level. We were also very lucky, to be honest, to get in the early days, about 3 foundations that believed in the mission and believed in our strategy for scale and gave us unrestricted funding. So we had that luxury to choose. And that allowed us to really stick to our mission and make sure we're solving. 70% of the young people we finance come from $2 a day households, right? Then in terms of just the capital structuring perspective, these are very, very long-term assets. And actually there's an asset mismatch here because these contracts go up to 13 years. Now finding capital in the market that is patient enough for 13 years is almost impossible. And so it really makes most sense to ring fence that risk and that capital and keep it off balance sheet, and sort of raise into SPVs, close it off, and then you sort of go on the blended finance journey. So do your first one with more philanthropic capital. Then, for instance, in this next fund, we will only have a 20% sort of concessional layer, and 80% will be a little bit more risk taking, so that eventually you get to a space where you're mostly commercial. This model has scaled in Germany by eventually raising money through retail bonds. So we've seen there's some good use cases, and so that's where you want to get to, right? You want to launch a bond with in Rwanda. We're speaking to one of the banks there. It's very early stages, but you want to launch a bond locally, have local private sector invest in this because it's their workforce, and then you can also have a more patient instrument. So that was why that decision was made.
Got it. Thank you so much.
Thanks, Batya. And then I don't know, maybe going back to Wendy's question around what systems, tools, or platforms are you currently using to track, measure, and report on your impact?
Oh yeah. So in terms of monitoring tools, the business model itself is data driven. So you have everything from the underwriting with the education provider to actually the onboarding of students, where we already understand baseline data like household income, etc. And then we're monitoring students right through their studies. We're a hands-on business. That's why there are 100 people, right? We look a little bit like a microfinance almost on the ground. And at every point in this customer journey, there's data that's being captured. So we're lucky to have a lot of the monitoring data in-house. And then when you get into repayments, it's pretty great data. It's probably some of the best around youth employment, youth income, how often youth move in and out of jobs, etc. We know that's not enough with impact. So that sits in Salesforce, our customer, and then we have a great data warehouse. In terms of the other evaluation that we do, it's with external parties. We're working with Bertha Centre on a study to validate some of that data and look for more data, right? A mix of qualitative and quantitative research, and then also looking at counterfactual data, like what is happening to the group that we're not serving, so that we actually validate our impact externally. I'm not sure if that answers that sufficiently.
I think that sufficiently answers
Okay.
the question. Thank you so much. Really appreciate it. Just to also say for people who are on the call and are hearing all these interesting terms and terminology, I think the last one Batya used was counterfactual. You've heard LPGP, you've heard blended finance, you've heard first loss, you've heard recoverable grants. If you are interested, these are some of the terms and teachings that we do as part of the Impact Investing in Africa course. And before people get going, and thanks, Jason, for posting the link in the chat, we'd like for you to all participate in a very short poll. And the question that we're asking is what areas need capacity building to ensure that impact investing success happens across the continent? A viewer is going to put up the Mentimeter. And then if we can you please put up the barcode? Thanks. There's a link shared in the chat as well. Would love to see your responses. We're obviously, I think the Bertha Centre is one of the pioneering organizations on the continent that is really committed to building knowledge networks, but also practical capacity needed to strengthen Africa's impact investing ecosystem. We're starting to see some of the responses coming in, but given that we have about 70 people still in the chat, we're hoping a few more will come in as we prepare to close off the masterclass. Okay, so we're seeing some really interesting comments and feedback, regulation and sandboxing, access to patient capital and awareness. I think Batya touched on that. Murendeni similarly, investment readiness, education on digital skills, business development skills and documentation skills, I guess investment readiness. FDB needs to do more. I guess that's a call to action for one of the large DFIs on the continent. Backing the entrepreneurs to be able to move their ideas from ideation to the next step. Definitely really key and important is ensuring that there is sufficient capital throughout the entrepreneur's life journey. DFIs need to do more. Understanding impact, gender lens approaches to Africa and focusing on investment readiness. There's also mention around financial management. What we've heard today from our distinguished speakers coming from Southern Africa, West Africa, and also focused on East Africa was that there are powerful models in action as it relates to impact, and that impact investing in Africa is not only a story of future potential, it is already happening. I think each of these models show what is possible when capital, innovation, and purpose are aligned. So perhaps the question we need to leave with following this really informative and insightful masterclass is how do we move from celebrating individual success stories to building the systems, partnerships, and capital structures that allow them to scale across the continent. Thank you once again to our amazing speakers, Adesuwa, Murendeni, and Batya, for sharing your work, your insights, your reflections so generously. I think for really being quite transparent around the work you do, how you work through your structures, and some of your key lessons learned. Thank you to everyone who's joined the masterclass today. Really hope this conversation offered you some practical insights, inspiration, and maybe a renewed sense of what is possible when African solutions are built from the ground up for African realities. We look forward to continue building this community of impact investors, practitioners, entrepreneurs, and the ecosystem actors committed to shaping the Africa's impact investing future. And we hope to see some of you who will be joining on our Impact Investing in Africa course that's taking place this September. It's from the 7th till the 11th of September. We've got an amazing curriculum that we've built. It's a week-long executive program and has over 400 alumni. So really excited. And once again, thank you for joining us today. Please do take care and enjoy the rest of your evening.
Thank you, everyone.